Did I get my, oh, there we go. Thank you.
Okay, we continue this, the second talk in this plenary session. Our next speaker is Professor Rafael Schiozer from the Fundacao Getulio Vargas from Brazil, São Paulo, and he made his PhD there and also spent several years abroad, at the University of Pennsylvania, visiting scholar at the Copenhagen Business School, and so one at the University of Illinois at Urbana-Champaign. And he's published many good papers, for instance, some in Review of Finance, Journal of Banking and Finance, and Journal of Corporate Finance. Today, Professor Schiozer will speak about bank loan forbearance evidence in million restructured loans, which in fact is linked to a project within University, which focuses basically on the financial inclusion of disadvantaged regions. So we are very curious about your results. The floor is yours.
Okay, so first of all, I would like to thank the organizers for having me here, for inviting me to come here. It's a great pleasure to be here at Corvinus in this wonderful city. It's my first time in Budapest, so I have enjoyed 2 days before coming to the conference. Well, this paper is uses Brazilian data, and it's a joint work with two co-authors, which happen to be from the Central Bank of Brazil, and just making a distinction between what was previously said. So we're looking at restructuring of non-financial firms' debt as opposed to household debt. Perhaps in the future I'll have a project and look into distressed debt from households, but at this time we're looking at non-financial firms, right? So I'll start with the usual disclaimer. So the opinions here are not from the central bank, they're from the authors, of course, right? So what is loan forbearance, right? So the definition by the BCBS is forbearance is a concession granted to a counterparty for reasons of financial difficulty that would not be otherwise considered by the lender. So there are many similar terms which are used in the literature. It might be renegotiation, it might be forbearance, it might be loan restructuring. So these terms are sort of used in an interchangeable manner. So sometimes you catch me up saying renegotiation or forbearance. By that, I'm meaning exactly the same thing, right? So when we talk about loan forbearance, at least from the financial stability perspective, there's two big types of forbearance. So we could classify one restructuring of a loan or a renegotiation of a loan, especially a distressed loan, in two big categories. So the first one is what we call good forbearance. So good forbearance is a win-win situation for the lender and the borrower, right? So suppose that the borrower has good payment capacity but is facing a temporary liquidity problem. So it could make sense for both parts, the lending bank and the borrower, to, let's say, change the terms of the loan, to elongate payments, to give some grace period or a deferment for restarting payments and so on. So this reduces potential losses with the loan. This avoids the costs of seizing and selling collateral from the part of the bank. And of course, it avoids a viable business from closing, right? So in some sense, good forbearance is something that's good for the economy as a whole. The second type of forbearance is what we call, of course, bad forbearance, right? And sometimes forbearance may be made for reasons that are not as noble as good forbearance. For example, banks may want to hide loan losses. They may want to not recognize losses by increasing loan loss provisions. So, of course, that affects capital ratios of banks, so they might want to look in their balance sheets better than they actually are, right? So forbearance is one way of doing that, right? So even if you know that the borrower is not going to pay, you as a bank may concede some deferment terms, or you may concede any other concession to the borrower, even knowing that that loan is pretty much gone, right? So this is bad because if there is any collateral, for example, the value of collateral is likely to decrease over time. So it would be better to recognize losses right away than just postponing losses, right? And there's plenty of literature showing that the pervasive use of loan forbearance by banks has very bad macroeconomic effects, right? So I think the most studied case is the case of Japan, where they document, so Hoshi and Kasha, they document that Japanese banks evergreen loans over and over to the same firms. So these were bad loans which were not written off. And then instead of giving credit to viable businesses, to new businesses, banks were allocating resources into zombie businesses that were almost dying, right? So, and this is considered as one of the factors that contributed a lot for the Japanese stagnation during the 80s and the 90s. And let me just give you an example on how banks might use forbearance for bad purposes, right? So let's say that we have two identical loans, and these loans are never paid by the borrower, so the borrower never repays anything. But in one case, the loan is not forborne, and at some time it's going to be written off. And in the second case, the loan is evergreen, so it's forborne over and over, every 60 days. Right? So most jurisdictions have some rule on provisioning based on the number of days past due of a loan. Right? This is the example for Brazil, but many jurisdictions have similar regulations. So this just shows that in panel A, a loan that is not forborne and the bank recognizes the losses as it gets more and more days past due, the bank is over time recognizing the losses, increasing provisions, and of course recognizing a loss. Right? On the other hand, in panel B, we see that if the bank evergreens the loan every 60 days, the provisioning is maintained at 3% of the value of the loan. The bank may accrue interest for up to 2 months, and that's the general regulation pretty much recommended by the BCBS. So even a loan that's 60 days past due, the bank may accrue interest on that loan and recognize it in its income statement. So the loan, even if it's never paid after 7 months or even more than that, if the loan is evergreen or renegotiated over and over, the bank shows a profit on the loan of, in this case, $92. Right? So it's obvious that banks, especially the ones that are in a weak position and need to window dress their balance sheets, they need to window dress their capital ratios and so on, they may use pervasively bank loan forbearance, right? So they may forbear loans a lot, okay? So what we do in this paper and what do we find, right? So we use a large Brazilian data set of loans that are 60 or plus days past due. We call them non-accrual loans because international regulation says that after a loan is 60 days or more past due, the bank can no longer accrue interest on that loan. So that's why we call them non-accrual loans. And we analyze how banks make decisions on whether or not to forbear loans. right? So what happens in these loan forbearances, right? So typically, loans are involve an extension of maturity on these loans, and other conditions may change, such as the collateral, the interest rates, and sometimes a deferment in payments. Right? So we start by describing what happens during a forbearance. Right? And why is it that Brazil might be important, not only for Brazilians, but the Brazilian example may set up some interesting insights for people outside Brazil? I think there are many reasons why. Right? First of all, there's some concern by the Basel Committee today that loan forbearance has been increasing, even though they don't have much data, or most jurisdictions don't have data on how much this is happening. Right? So the good thing about Brazil is that banks are required to disclose to the central bank each and every loan forbearance that they make. Right? So even if there's a loan that is unpaid, and then the bank grants a new loan to that same firm that encompasses paying the old loan that is past due, that has to be reported, and that is considered a forbearance. Right? So this very rich data allows us to understand how banks make such decisions, and this is not only about Brazil, right? So we're just happy enough to have the data in Brazil. Right? So what we find in this paper, so beyond just describing what happens during a renegotiation process, right? So we find that larger loans are more likely to be forborne. That's more or less obvious why. Right? We find that the type of collateral matters, and this has to do with the literature on law and finance, or creditor rights and finance more specifically. Right? So we investigate this, and we look at the type of collateral, how easy it is to seize and sell collateral. So whenever it's harder to seize and sell collateral, banks are more likely to renegotiate, right? Because of course they avoid a costly process of seizing and selling collateral. Right? It also increases, the likelihood of forbearance increases when the same borrower has a good loan, so a non-defaulted loan with the same bank. And this might mean two different things. This might mean that, okay, the borrower has been showing some repayment capacity in another loan. So if we're looking at a particular loan that's defaulted, it might make sense to renegotiate this loan because this borrower has some repayment capacity. But it may also be reflecting some regulation that exists today that requires banks to make provisions based on the worst loan that a single borrower has. Right? So if the borrower has a good loan and a bad loan, banks might have an incentive to forbear the bad loan to avoid provisioning too much for the good loan. Right? So this might be a regulatory incentive to forbear loans. And this is probably a bad incentive. Right? So we also show that when the borrower has not defaulted on other loans but with another bank, then the loan is less likely to be forborne. Right? And that's, again, for more or less obvious reasons. Right? So if you're repaying someone else, why should I concede you some extra time to pay me back, right? So I shouldn't be doing that, okay? And finally, we show that previous forbearances on the same loan increase the likelihood of a given loan being forborne again. So banks are more likely to give concessions to borrowers that have previously, or to loans, specific loans that have already been granted some concession in the past, right? And this is a big indication of what we call zombie lending or evergreening, right? So The more a loan is restructured, the more likely it is to be restructured again and again and again. Right? So this is, in terms of financial stability, it might pose big problems to the financial system. Right? And finally, we look at the effect of court enforcement on forbearance. Right? So there are some papers that are starting to look at that. So what's the role of courts in economic growth, in financing firms? So, and we show that court congestion increases the likelihood of forbearance. So we use cross-sectional variations across different Brazilian counties or municipalities, so there's 5,000 of them. And we see that in places that have faster courts, banks renegotiate less because it's easier to seize and sell collateral in faster courts, as opposed to in places where courts are very slow, so they're very congested with other stuff, and then banks are more likely to renegotiate because, of course, it would take as long as 10 years to recover some collateral, so it's better off, banks are better off buying an option and giving the client an option to pay back the loan instead of waiting 10 years to recover collateral. Right? So I was mentioning this is pretty much the related literature. So there is some literature on the renegotiation of financial contracts, but of course this is more focused on contract design and how renegotiations take place. It's more focused on non-distressed debt as opposed to our study, which is basically composed of non-accrual loans or loans that are already past due. Right? It also relates to regulatory incentives and financial stability. It relates a lot to the zombie literature, zombie lending literature. And it also relates to, in a broader sense, law and finance papers, more specifically to creditor rights and collateral, and more specifically to court enforcement. Right? So this is how we contribute to the literature, I think. So what is novel in this paper and why should one care about Brazil? So I think what is novel is that we have a precise definition of forbearance. Right? So we don't use proxies as all the other papers do. We have a very large database, so basically we have access to all the loans that are past due in Brazil from 2012 on, and whether or not they have been forborne. So this is almost the population of loans in Brazil. We explore loan features not explored before, such as locality, municipality, and so on. Right? So I think I've gone through this. So it's novel in the sense that in a low environment, enforcement environment such as Brazil, we show that enforcement matters and creditor rights matter. So this could generate policy implications for any such country in which basically civil law countries that in some sense have a low enforcement environment and less creditor right protection, right? So I think it applies not only to Brazil, of course, right? And in terms of financial stability, of course, the design of regulation to try to not create incentives for banks to make bad kind of forbearance, of course, right? So how big is debt? How pervasive is this? Right, so this is a figure taken from the Financial Stability Report of the Central Bank of Brazil. So in essence, the blue line shows what banks report as loans that are 90 or more days past due. And then if we add loans that were in this situation but were renegotiated, were forborne, then we have this orange curve over there. Right? So the problematic assets go from around 3% of banks' assets to somewhere around 4.5% of banks' assets. So it's a lot, right? So in dollar terms, we're talking about around $8 billion in forborne loans. Right? So it's not a small thing. So what's the data that we use? We use data from the credit registry in Brazil, as I said, from 2012 to 2018. All loans above 1,000 reais, so pretty much $250, so almost all loans made to non-financial firms in Brazil. We have 13 million non-accrual loans, so loans that happen to become 60 or more days past due. We do a robustness check with 30 or more. The results are essentially the same. We have, from these, 1 million have been forborne. Right? So around 9% of the loans that have become past due, 60 days or more, are forborne. But in value terms, it's 20%, so it's a lot more. We have more than 1,000 financial institutions. We do a robustness check with the 100 largest banks just to check, and the results are the same. And we have 2 million borrowers that have defaulted or at least become past due at least 60 days on their loans. Right? And loan level data includes all these characteristics of the loan. So what's the value and type of collateral? What's the type and purpose of the loan? What's the currency, maturity, payment terms, interest rate, and so on. Right? And then we also use other data at the bank level. So we use supervisory data and basically accounting data. We use that from the central bank as well. And we also use data at the borrower level, so industry, location, type of control, number of employees, which we use as a proxy for size. Okay? So I start by describing the data because this is a pretty novel database, and I think loan forbearance is pretty novel in the literature, so I'm spending some time here describing the data. Right? So here we list the 1.1 million loans that have been forborne, and when does forbearance occur? Right? So when do banks renegotiate with their borrowers? And this is on the horizontal axis, the number of months after the loan becomes 60 days past due. So in essence, what I'm showing here is that a loan is likely to be renegotiated soon after it becomes past due. Right? So the probability of renegotiating after it's long due is really small. Right? So more than 80% of forbearance events occur up to 4 months after the loan becomes 60 days past due, or it means 180 days after it started being past due. Right? So here we look at how size affects the probability of forbearance on an univariate analysis, of course. So on the horizontal axis, we split the loans into their values. Right? So a very small loan in the first decile in terms of value has a chance of being forborne of around 2%, as opposed to if we go to the 99.9 percentile, then we have more than 1/4 of the loans in the upper part of the distribution are forborne. Right? And if we take an average over the number of loans that are forborne, this is 9%, but if we take an average considering the value of the loans that are forborne, that reaches 20%. Right? So again, that's a lot. Right? So a great part of distressed debt for non-financial firms is renegotiated in Brazil. Okay, and this happens. This value effect occurs across different loan types. So no matter if it's financing real estate, foreign trade, infrastructure, investment, working capital, or whatever, this loan effect, this value effect is there, right? So the main message is across the board, larger loans are more likely to be renegotiated. Okay? Then we move on to a more, let's say, multivariate analysis description. Again, we're not at this point claiming any causality here because, of course, there's nothing exogenous going on here. But we try to control for as many omitted variables as we can, right? So for that reason, we try to investigate what drives forbearance, and our dependent variable is a dummy variable on whether a loan that's past due has been forborne or not. And then essentially we try to look at this decision within the same bank at the same time, so we use bank month fixed effects. We try to look at similar loans, so financing similar things, so we use loan modality month fixed effects, so the same type of loan in the same month. We try to compare similar borrowers, so we use industry month and municipality month fixed effects. And of course, then we're looking at variations in these different variables of interest, which basically I'm going to walk you through the regressions the regression results in a second. Right? So this is a big table. I'm not willing to show you any numbers on this particular table. The only reason I'm showing this is that the inclusion of fixed effects or not doesn't change much of the inferences that we make, right? So on model number 1, we have no fixed effects at all, and in model number 5, we have a completed saturated version of our model. So in essence, that's where we compare very similar, the same bank in the same month, similar borrowers, same types of loan, and so on, right? And this is just to show you that the coefficients are very stable no matter what type of fixed effects we use. So it's not the case that fixed effects are correlated or too much correlated with our variables of interest, right? So this is just to show you that. So then again, I'm showing the results of my preferred specification, which is the one with all the fixed effects that we can put in this regression, right? So again, we show that having a performing loan with the same bank increases the likelihood of forbearance by 1 percentage point, more or less. We show that guarantee types matter, right? So creditor rights decrease forbearance, and the logic here is that fiduciary lien is the simplest type of guarantee in terms of easiness to seize and sell collateral, right? So in this case, in fiduciary lien, the collateral is, the property of collateral is given to the bank, and then the bank just needs a simple authorization from court to go there and sell this collateral, right? As opposed to mortgages and other types of collateral, right? So the easier to sell collateral, the less likely a loan is to be forborne. And the reason is if it's too hard to seize and sell collateral, we will not do that. We will renegotiate this loan. Right? As I said, previous forbearances increase the likelihood of a new forbearance, right? And we have loans with as many as 20 previous forbearances, so believe it or not. So this means that if that is true, if this is really linear effect, so a loan with 20 previous forbearances as compared to a loan with any previous forbearance has 20 times this coefficient, so somewhere around 16 percentage points larger chance of being forborne again. Right?
Can I ask a question?
Sure.
Do you know what happened to the loan between the two forbearances?
That's exactly what we're trying to investigate at this time. So I'll have the answer for you in a month.
But if you don't know, then is it not a bit too brave to say that this is an indication of wrongdoing? Is it not possible that it's the precise reason why they do another one is because the first one started to work?
If it's really repaid, then it wouldn't be forborne again, right? So that wouldn't be classified as forbearance because we're only considering the same loan to be forborne again if it becomes 60 days or more past due, right? So it doesn't, of course, indicate that the borrower has no payment capacity, but it has defaulted on at least 2 installments if it's the case of monthly installments.
But the bank could have gotten quite a lot of money prior to the 60 days.
Yes, that's true. I would assume that this is not the typical case, right? But I should look into that to have a precise answer for your question. Right? But you're correct. But it's the same loan being defaulted again, so that's that's at least some suggestion of evergreen, right? And finally, as we have shown, so larger loans are more likely to be forborne, right? So how much time do we have? 5 minutes, okay. So then we move on to something that we believe has more, let's say, of an identification strategy in the sense that there's something exogenous going on in there, right? So there's a previous paper by Ponticelli and Alencar in which they verify that court efficiency in Brazil at the municipality level affects the supply of loans. And their logic is that banks are more willing to supply loans if in the future, in the event of a default, it's easier to seize and sell collateral. Right? So this is their logic. And they really show that there is a loan supply effect in there. Right? So we claim that if their rationale is correct, we can bring further evidence on this channel. Because, of course, if their rationale is that banks are more willing to supply loans in places where it's easier to recollect collateral, then, of course, banks would be more likely to renegotiate loans where courts are more inefficient or more congested, right? Because then again, this would show that banks would avoid this very long process of seizing and selling collateral and so on, right? So, and we are lucky enough to have 2 types of loans that should depend on courts and 2 types of loans that should not depend on courts, right? So, loans with guarantees that must go through court, that should matter for these types of loans. For loans that are unsecured by any collateral, these should not matter. And for loans that, for which seizing and selling collateral shouldn't go through courts, this should not matter as well, right? So this is pretty much what we do in this sense. And so we use a measure of court efficiency, which is only available from 2015 on, so we lose part of the data, but I think that's all right. And we claim that this court congestion thing is reasonably exogenous because most of the cases that courts are required to analyze are not related to bank loans at all, right? So we show that approximately 90% of the cases are unrelated to bank loans, so these courts are congested or not for other reasons that are not related to how much banks go to courts to have collateral back, right? So these include all types of non-criminal stuff that go through courts in Brazil. So it could be divorces, family disputes, commercial disputes, and so on, right? So we measured the average time in court for the 5,000 different counties that we have in Brazil, and just for you to have an idea on the cross-sectional variation. So this average time in court can be lower than 3 years for the 10% quickest courts and over 11 years for the 10% more congested courts, right? So it makes a lot of difference in practical terms, right? And then we do this test with the continuous variable of court congestion, but I'm showing you the the results which are easier to interpret, we simply split between the courts with above and below median level of congestion. Right? And then what we show here is that if we look at all loans, the time in court affects the probability of congestion. So the slowest the court is, so the more congested a court is in a place, the more likely banks are to forbear a loan, because it will be hard to collect collateral. Right? And when we split that into different types of collateral, so fiduciary lien, mortgage, these are the ones that must go through court, and lien in a, let's say, quicker process, and mortgages in a somewhat slower process, but it also has to go through court. And then others that don't require going to court, or loans without any collateral, the result is there, right? So in essence, the time in court matters for loans with better quality in terms of there is some collateral there, and that needs to go through court to be recollected, right? So the, let's say, non-treated or non-sensitive to court efficiency, in fact, court efficiency doesn't matter, so whether a loan is forborne or not in these circumstances is not affected by how that particular court is congested or not, right? So we do a bunch of robustness checks. I'm running out of time, so I'll be quick in that. So we use only the 100 largest banks. Results are the same. We exclude state-owned banks because they could have some incentives to forbear more for some clients than others. Results are the same. We use loans that are 30 days past due instead of 60. Results are the same. We do separate estimations for each type of collateral in the previous regressions. Then again, results are the same. And in terms of borrowers, we exclude one industry at a time, so, and results are the same, right? So in 1 minute, I'm trying to give some guidance on where we're planning to go with this paper. So I'm happy to hear the comments and your suggestions in these papers. So we're looking at whether bank relationship matters in this process. So is the process, does the fact that the bank has a longer relationship and perhaps more information about the borrower, does that matter for the process? What is the effect of a single firm having multiple relationships? Is that harmful for the firm or not? Are weak banks more likely to forbear? We haven't touched on this subject yet. Theory would suggest that they should or they could be more likely to forbear loans for bad reasons, right? If so, what is the channel? Is it income smoothing? Is it capital requirements? We're looking at what happens after forbearance. So are loans paid? Are they defaulted again? Are there observable features driving whether restructuring works or not? So that could be interesting for insight for policymakers as well. And finally, we're trying to look at the real effects of forbearance, right? So what happens to the firms after some time, right? So do they recover? Do they invest again? So this will involve much more data collection. So this is the, I would say, the hardest part in terms of managing the data, but that's where we think we could go with this paper, okay? So thank you again for listening, and I'm happy to hear suggestions, questions, and whatever, okay? Thank you. Yeah.
The question about the non-performing loans which were not forborne. So do you know what happens with those? Is it common that they actually seize the collateral and stuff? Or do they start to pay ever?
Well, I'm telling from my feeling from speaking to bank managers and not from the data, right? But most of these loans are written off, and after 1 year or so, they're sold to collecting companies, right? So But it's not very common that, and to be more precise, it's very uncommon that loans are sold to a third party outside the financial system before they're written off, right? So it's very uncommon for that to happen. So, but I would need to look into the data and tell you what happened, yeah. More questions?
Thank you. I would like to see what is the difference between loan forbearance and debt to equity swaps as two very similar tools of crisis management. Have you seen some data on debt to equity swaps, for example?
In this case, what we classify and we have registered as forbearance is debt to debt. Right, so it's a credit operation. It continues to be a loan, right? I'm not sure how many of these forborne loans eventually will become or be converted into equity. I would say it's not very common, but then again, it's my feeling. It's not the data. I would have to look into the data to precisely tell you what actually happens.
Any more questions?
Let's go to Peter.
You mentioned in the beginning that you actually differentiate between good and bad forbearance. But do you take that into account in the analysis, whether a forbearance was good or bad? Would it be useful for anything?
I would say that's almost impossible to clearly distinguish between good and bad forbearance from an empirical standpoint, right? So I assume that even banks sometimes are dubious about whether debt forbearance is good or bad, right? So because actually it depends on the outcome, right? So and it depends on your expectations about the outcome, and of course it's a probabilistic thing, and it's not a deterministic thing, right? So the bank doesn't know at that point when it renegotiates a loan whether that loan is going to be repaid or not. But of course, we can have some sense on if banks are forborne over and over, that might be a sign that banks perceive or have an expectations or have little expectations on that loan being repaid again. Right, so that might be being made just for cosmetical purpose, just for window dressing, balance sheets, and so on. Right? But it's very hard to actually distinguish whether forbearance is good or bad ex ante. Right? What we're doing right now is we're looking at the outcome, right? But the outcome doesn't tell whether forbearance is good or bad, or was good or bad ex ante, right? So it gives an indication of, okay, if too many of the renegotiations turn out to be loans that are never paid, then this is a suggestion of ex ante bad forbearance, right? But it's not necessarily the case. It may be the case that the bank concedes some deferment or some lower interest rates and so on to borrowers in, let's say, in good hopes, in the expectation that the borrower is going to repay, and for some reason it ends up not paying back again, right? So as any event with credit risk, we cannot tell in anticipation what's going to happen, default or not, right? But what we're planning to do is we're looking at whether the outcome of, for example, weaker bank or forbearance in weaker banks is on average worse than in, let's say, comparable stronger banks. Right? We could try to match loans between the ones that are forborne and not, but of course there's always an observable feature that made that particular loan be renegotiated or not, right? So even matching is very weak as a sort of actual test on good versus bad forbearance in this case, right? So what we're trying to get at is real effects, investment effects. So do firms recover from that? So are firms better off renegotiating or not on average? But this is to some extent endogenous, of course. Right?
Can you tell ex post then?
I will be able to tell perhaps in a few months, but that's exactly where we're working on.
Interesting if you could develop a model that can actually tell SMs whether it could be good or bad. These are your data ex post. So if you can set ex post, then you can.
Yeah, that's exactly the idea. So
Could be valuable.
yeah, we're on observables. Of course, we're building a model that explains forbearance, and based on that, we're going to compare comparable loans in terms of the outcome, right? So that's the idea.
Okay, we run out of time. The conference dinner will be at 7 p.m. at the Hungarian Academy of Sciences, close to the chain bridge. So you can either walk there 15-20 minutes or take line 2 for stops. But maybe the organizers have some instructions in this respect, so I